I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks once again for having me.
We're wondering where gold and equities are about to go. Well, what are we in their cycles?
Well, with gold, I still am not convinced that we've seen the bottom. Obviously, we've had a nice bounce. I still think that, there's at least a retest of the low, and before we get the higher degree so-called 9-year cycle low, and then I think there's going to be real opportunity in gold at that point. As far as equities, the insanity continues. I've spent this week working on my May research letter and looking at stuff, and I know that this advance out of the January, February lows has been fairly convincing. But when you look at the structure and you stand back and look at everything, it's changed nothing. We still have a Dow theory primary bearish trend change from last year. The structure of the market's still negative. It still looks like a counter trend advance. And, you can, on the one hand, try to argue that it's something other than that. But when you stand back and you look at the structure, again, it's nothing, absolutely nothing has changed. And if you look, for example, when I say nothing has changed, for example, I'm looking at a chart of the S&P. It topped last year. We made a low in August, and then we rallied out of an intermediate degree cycle bottom and made a higher low, and then we made a lower intermediate degree cycle low in January, February, and now we got close, but we've made a lower high. And you go through the charts and you look at that, and you look at the the NYA, you look at even the Wilshire, the broad-based Wilshire 5000. That structure, that negative structure, is still there. So, if you want to argue the bullish side and say, yeah, well, but the rally's been up for what? I forget now how long this advance has been going on, 10, 11, 12 weeks. I don't care. The structure is what matters, and the structure is still negative. And so I think that until that structure changes, improves otherwise, it is what it is today. And what it is today is that this is still a counter-trend advance. It is the ultimate mind game in that it has become very convincing for the bulls to pull them in, and it has caused tremendous doubt for the bears to make them question their position. And I still think that it's trying to set up for the next leg down.
As an analyst taking a look at charts as well, what about the Baltic Dry Index, which is a good indicator of the movement of goods by sea?
Well, I think that we had, I track that. I don't watch it every day, but I do report on it, and there is a cycle in commodities in the Baltic Dry Index that is pretty much, I will say, unmanipulated, if you will, because of, it's pretty regular, and it moves to a 3-year rhythm, and in looking at that, we possibly, I say possibly, I think we saw the 3-year cycle low in early 15 on the Baltic Dry Index. And then, again, looking at that structure, we rallied into the middle part of last year. and it was a lower high, and then we go down and we made this low in early 2016, which is a lower low, and then we've rallied, and everybody got excited about that. Gold went up, oil has gone up, everything's rallied, and has, I guess, given the commodity crowd a reason for some hope. But the structure, when you stand back and look at this cycle, it's still broken, and that's part of that trap, I think. I mean, it looks like that we've seen another 3-year cycle top last year. It looks like a left-translated 3-year cycle top, which means that these bounces are counter-trend and that it's going lower. And until that structure changes and proves otherwise, I mean, it is what it is today, and that is certainly what it's telling us. So, and then more recently, we've seen the Baltic Dry Index begin to roll over. I think that could be telling us something about commodities, possibly gold, and even equities.
Gold, of course, you say is on a 9-year cycle. Have we hit the low, and has it got nowhere else to go but straight up?
Well, I don't think it has anywhere else to go but straight up at some point in the future. But no, according to the norms, according to typical cyclical behavior, there has been, it's not exactly a 9-year cycle, it's more like a 8-year cycle, but there's been 9 of these cycles that approximately run, on average 10 or 11 months. So, you string 9 of those together and you come up with about 8 years, or a little more than 8 years. But that cycle, there's been consistently 9 of those 10, 11, 12 month cycles in every 9-year cycle. So that's why I call it a 9-year cycle. Well, we haven't seen the 9th one yet. And so that's what I'm saying. I think we have one more of those cycles to complete the higher degree 9-year cycle. It may just be a retest of the low. I mean, it wouldn't hurt my feelings to see it violate the low from last, December, I believe it was. But I do think there's another trip back down, and then I think that we have a tremendous opportunity with gold and gold stocks. I just don't think we're there yet.
We'll have more with Tim Cyclesman Wood right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, oil over the past few months has had a very nice rise, coming out of the low 20s into the $45 range. Will that be sustained? After all, I'm hearing that the demand for gasoline has been stronger than many anticipated.
Well, when you look at charts, you're not looking at, obviously, the fundamentals or what's driving price. You're just looking at price and the behavior. And we know, and we knew going into the February low, that there was the seasonality. There's a couple of things. You have a cycle that's approximately a year long in duration there, and then you have a seasonal factor. And the seasonal factor is not like clockwork. I mean, it's a tendency. It's not a hard and fast cycle that goes from this date to this date. Oil goes up, and from this date to this date it goes down. It's just a tendency. And the tendency is that you get a bottom the early part of the year, and then you rally through the summer into the driving season. And sometimes that seasonal tendency will find its peak. I've seen it peak in May. I've seen it stretch out into August. But the tendency is lows late in the year, early in the year, and then you rally through the summer driving season and then down. And so we've seen, in conjunction with that seasonal tendency up, we had a intermediate degree cycle bottom. At this point, we can't say if we've seen the higher degree low. I had projections on oil to take us down into the 20s. Those projections were met. So from that perspective, it's possible we've seen the bottom. Now what I have to see is how the structure, how oil behaves when this annual intermediate degree cycle concludes. And that's not avoiding the answer. It's just it is the answer. I have to see what the structure of this cycle looks like, and this cycle hasn't run its course yet. I think, as with gold, there's at least a retest. That's my best answer. And I can't rule out the possibility that there is a lower low there, but I think there is at least a retest of the lows in crude oil.
What about other economic indicators that show perhaps the U.S. is near recession or in recession? Say, for example, heavy construction.
Well, I think all the indexes pretty much, I believe, are in counter trend bounces. Some of them, heavy construction is actually one of the better ones. I still think that it's in a counter trend bounce. You look at housing, home construction, they don't look as good. You look at, for example, airlines. You know, that index does not look as good. You know, you look at the trucking index. If you dig beneath the surface of the transportation index and you look at the trucking index, it looks a little weaker. So there are, I think, varying degrees of weakness and strength. You know, in other words, some are a little stronger than the others, but overall, again, I think that everything has been in pretty much counter trend bounces, and that it's been terribly confusing for both bull and bear alike. I said a long time ago back in July, August, when the initial leg down came, I said that there would be false hopes and false bottoms. And I think that this is a prime example of a false bottom coming out of the January, February low, and I think it has definitely spawned false hopes. And I realize that this is you know, the same song and dance, and some find it hard to believe, but it is what it is. I mean, you know, it's not a fairy tale. It's not an opinion. It's a hard fact that we have a Dow theory primary bearish trend change in place. It's not an illusion or a matter of opinion that we have the negative structure in all of these indexes that we have. That's a fact. And it's not even debatable. I mean, you can look at it and go, well, yeah, that high is lower than this one, and this low is lower than that one, and so the structure is negative. The trick is dividing it up into cycles of the same degree and recognizing that. Where the trick also is the fact that this thing has taken so long to evolve and unfold, is that it's kind of like, I don't know, crying wolf. After a while it becomes hard to believe, and I get that. I understand that. And that's part of what makes this thing so darn dangerous. No one, or I say no one, it makes it hard to believe. It makes the Dow theory primary bearish trend change, I don't know what words I'm looking for. It makes you question its credibility, if you will. I get it, but it's there.
All these central banks with their quantitative easing over the past few years, what they've done is they've been building a wooden bridge over a pit of fire, but after a while that fire is going to burn that bridge, and the longer and bigger they make that wooden bridge, the worse the fall's going to be, isn't it?
That is absolutely correct. I mean, if you just think back in history, and it's not doomsday. I mean, and I'm not a perma bear, and I don't wish all this. It's just, I'm a realist, and it is what it is. So let's get that out of the way. I would wish nothing more than they would have left things alone. We would have gotten the flush out, and we'd be on solid ground and on our way now. That would be wonderful to have a real flush out and a viable economy that was recovering instead of one that we keep putting the Band-Aids on. But that's not where we're at, and this thing is still strung out, and there has been a coordinated effort to keep it going, which again I understand. I mean, like I said before, if you or I or the next person was in that position, we'd probably all be trying to do the same thing to try to rekindle and keep things going. But history shows at the same time that it has never, ever worked. Not once. Ever. I mean, somebody send me an email and show me one time, one example in history, just one, where any degree of manipulation has ever worked long term. How did the tulip mania work out? How has any other manipulated, parabolic, extended advance ever ended? The question is, how long can it extend? Well, hell, I don't know that. I do know that it's what we have, and that in 2015 we finally saw the setup, and that's concrete, that's in place. How it unfolds, I don't know.
Is this going to be the year where sell in May and go away actually works?
Who knows? The setup for that is there. The risk is there. And at some point, it's like holding a greased pig. At some point, you lose control. And when you do, the dominoes are going to start to fall. And so all I can say is that, it is what it is. The setup's there. We're dealing with the most extended, and I hate to even use the word, because that in and of itself has even become, discrediting to use the title 4-year cycle. But that's what it is. I mean, since 1896, it's been a 4-year cycle, and we're in the most extended of those cycles ever, and we're still near the high. We're set up to go to into a low that hasn't begun. I mean, it hasn't even really begun.
And how desperate are governments in Japan, where they've gone to negative interest rates, which has not done what they hoped it would? Because there's a reason I think perhaps the world never had negative interest rates before. How does a bank make money? How do insurance companies make money? How do pension funds make money with negative rates?
Exactly. And if things were so rosy, why would this be going on? Why would there be this coordinated effort to do this in a perfectly normal, healthy, true secular bullish environment? It wouldn't. So, the fact that we've held on and it's the can's been kicked down the road is one story, but the fact that it is an extended, most dangerous stock market environment since the exception of the averages in 1896 is another. And I'm telling you that the risk associated with that is there, and they're real. And eventually they will, the statistics associated with it will come to pass, just like they did with crude oil. I mean, it's just math, and the market will have its way.
Tim, what kind of advice are you giving people in your newsletter?
Well, I don't really give advice in the newsletter, believe it or not. I tell, it's a research letter, and what I do is I lay out what I see with the market. And then one can do with that as they please. I mean, I'm not going to tell someone, go buy stock A or B or sell stock A or B or whatever. I tell and show what the cycles of various degrees, what the forecasts are, just like with crude oil. When I said that crude oil was going into the 20s, I didn't tell anyone to go sell crude oil or sell their crude oil stocks. If that's what they do and that's what they want to do, or if they see opportunity with that, that's fine. I mean, that's up to them. So it's a research letter as far as direction and why, and it's backed up with statistical and cyclical data, and what one does with that is up to them.
An informed and educated investor is a much safer investor, right?
Well, it's like, what was the line in the movie Wall Street, Gordon Gekko? He said, when he was talking to Bud Fox, what was it he said? He said something to the effect that the most valuable commodity is information. And so, yes, I agree. And here's the other thing. Speaking of that, I have had this happen to me more than one time. Like after the decline, I preached and preached and preached in 2005, 6, and 7 about the extended 4-year cycle advance then. At that time, that was the most extended cycle. And I stuck to my guns because I had hard statistical data. And I said, and my DNA markers. And I knew that it was an extended cycle. And I knew from history that no time in history has an extension like that ever not made matters worse. Plus, I had data that told me that we should go below the 02 low when we declined into the 09 low, or when it eventually cracked and went into at the time I didn't know it was going to be an 09 low, but when we eventually cracked and went into the next 4-year cycle low. And so all through that time period, I stuck to those guns because that's what the data told me. And and then when it finally happened, and people that weren't privy to that information through the newsletter or had never heard of me, they came to me and they said, "Oh Lord, if I just would have had that letter, if I'd have just known about this." And gold, I wrote about gold. I wrote about how gold was, we had the 9-year cycle top there, and it went down. And I've heard the same story over and over again throughout these cycles. That if I'd have just had that information, but the reality of it is that I could hand that letter out on the street corner for free. And a small percentage of the people will take heed to the research, because people have an opinion that more times than not is invalid, and they're going to stick to their opinion come hell or high water. They're going to validate their opinion based on something, but when you peel back and really examine the basis, more times than not, it's hollow. And so, I don't even know the point I was trying to make, but I guess the point is that the research is statistical based. Sometimes it seems outlandish. In 2008, to say that crude oil and the CRB index had topped and the commodities were coming down, when everybody was calling for peak oil and $200 oil sounded crazy. To say that we were going to have a decline in 2000 following the 2000 top below the 98 low sounded crazy. To say that gold peaked in 2011 sounded crazy. To say that oil was going into the 20s 2 years ago sounded crazy. To say that this is the most extended stock market in history, and the statistics associated with the consequences of the unwinding of it sounds crazy.
Well,
but the
data's
data's there, and if anyone's interested, it's worth taking a look at, I think.
I was going to say people just hate hearing bad news and they don't want to believe it. But take a look at the facts.
They don't want to believe it, and that's what I'm saying. Take a look at the facts. And I want people to also understand, I'm not just permanently bearish. It would be much easier to sell people what they can see. It'd be much easier to come forward and say, "Oh yeah, things are great, and here's a good stock to buy, and things are going to," that would be an easy sell, to try to convince people of the obvious. Trying to convince people of something they can't see is much more difficult. Why the hell would I want to make my job difficult by being permanently bearish? My opinion is based on data, and until that data changes, I am not changing my opinion. I can't. I hope that's a little background to make people or insight to help people understand, the basis for what I've been saying and thinking.
Tim, thank you very much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. You can forward questions or comments about the show to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.